Welcome to Market View with Ike Iosa and Friends. This show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now.
Let's say good morning. I'm actually your host for Market Guest, my very good friend, Mr. Mark Arbeter. Hi, Mark. How are you?
Great, glad to be here.
My pleasure. Mark, I was looking forward to speak with you today and get your thoughts on the market. I'm looking at the S&P. Today is the fourth consecutive day that price has held above key support at 4,200. 4,200 is key support for multiple reasons. So at least for the short term, that's a win for the bulls. Can we expect continuation of today's rally into next week and beyond?
Yeah, I think it's still up in the air. Certainly today is a positive. My title here, as I enter my 10th year of newsletter writing, was a weak bull or a developing bear. And I think the great sports analogy for today's action, coming in, listening to commentators from yesterday and this morning, and, we get a hot number, look out below, and that's the way things were looking for a little bit. But, in sports, that's why they always play the game, so that's why they always open the market. When you have a bad team versus a good team, spreads wide, everyone puts the money on the better team, and, you still got to play the game. What's interesting here also is I don't think we can argue that from a interest rate perspective, the numbers today were certainly bearish. We have yields way off their highs, though, today. So it's not the news that's important. It's always the reaction to the news. So if we look at chart number one, this is a short-term chart of the S&P 500 going back to about February. Has the bullish channel that has existed since March that we broke here in late August, early September. And so far, as you said, we have pulled back to a level of very strong support around 4,200. As you said, it's the 200-day average that sits there. It's also the last breakout level, which represents strong chart support. And there's a couple Fibonacci retracements that come in right around the 4,200 area. So it was an area where there was a cluster of support, and certainly an area that I was looking for at least a bounce. Whether this is the end of this, what looks like an ABC or a three-wave decline, I'm still not sure. One day doesn't make a trend, but we've got some good footing here, at least going into the weekend. If we look at the second chart, also a daily of the S&P 500, going out to the end of 2021 and the peak in early 2022 for the S&P 500. You can see that the bullish channel broke, early this week, last week, and now the S&P has rebounded here right off that green wavy line, which is the 200-day moving average, and prices are trying to get back into the channel, which I think would be a start here to turning this little pullback. So far it's been a little pullback, turn it around. But so far, the area of chart support, me and everybody else has been talking about, held very nicely here today. Going to the third chart, it's a daily chart of the triple Qs, going back to the summer of last year. The bullish trend line comes off the January lows, just the way prices acted, not off the October lows like the S&P 500. The worry here for the Qs is that, at least the worry for me was that when we started to pull back, the breakout level for the Qs and the Nasdaq was way down, like around 320. We haven't even gotten close to that level, and the 200 days down at 330, 150 or so. So far, Qs have actually held in here a little better than the S&P 500. And if we scroll down, we look at the five largest stocks in the Qs and the strength that we've seen in the market this year, which has held up the major indices and masked a lot of weakness almost everywhere else. But we got Apple above its 200-day, Microsoft above its 200-day, Amazon, Google, and Tesla all have pulled back, all broken or close to breaking their short-term to intermediate-term uptrends. But certainly we don't have any real bearish longer-term charts here in these highly, mega cap weighted stocks. Moving to the problem area here, chart number 4. On the top panel, we have the S&P 100, the OEX, could be either one. It's percent of stocks above their 200-day or longer-term moving average. Generally, I don't like to see us break and stay below the 45% level. If you look back here, we broke that in 2015, in 2016, in 2018 during the pandemic, and then in early 2022, and they were consistent breaks. The pandemic, of course, didn't last that long, but when you break the 45% level, historically, even going back further, it usually signals some danger. The breadth is so weak that the markets will develop into a major correction and or bear market. If we go to the bottom panel, this is the percent of stocks in the Nasdaq 100 or triple Qs. That's still holding in there at 60%. So as I said before, as everybody knows, it's been a market of the big guys, and the rest of the market doesn't look very good, at all. I would say the majority of stocks, 80-90% of them are in bear markets or in pretty serious downtrends. I took a look from the top when the NYSE and the SPX peaked around July 31st until their recent lows around October 3rd, pullback lows. And they had been down, both of them, about 8%. That was a 45 trading days. So far, a normal pullback. But when we open the hood here, look under the surface, the average in those 45 days of stocks advancing is around 800 issues, and the average decliners during that period on a daily basis is around 1,000. So rounding that off, get to a net of negative 200 issues per day over a 45-day period. That's the weakest breadth reading since the bottom of the bear market in October of 2022. Other periods that we saw this breadth measure get really weak was in 2018, 15, 16, 2012, 11, 2010, during the mega meltdown in 2008, 2009, August of 2007, which was before we started lower, June of 2006, and then back in the other mega meltdown during 2002, 2003. So from a longer term, intermediate to longer term perspective, I'm quite concerned about the overall breadth picture. And during the first 3 months of recent bull markets, this 45-day average will reach plus 250 or to 325 NYSE issues and stay high for about 70% of the advance. And during the rally since October up to its peak there, the measure reached, as I said, almost reached plus 200. So it's been a slow bull market as far as reaching 20+%, and it's been very weak on a breadth measure relative to other bull markets. If we move to chart number 5, this is also a breadth chart. Top panel shows the equal weight or the average S&P 500 stock versus the weighted or normal S&P 500 that we look at. It's just a relative strength line. You can see that the average stock versus the weighted S&P has been weak since the beginning of 2023. Has that hurt the market? Well, it depends what market you look at and what indices you look at and what particular stock you're looking at. If it hasn't hurt the S&P 500 or the Qs or the Nasdaq, but as far as number of issues being very weak and small caps, mid caps, NYSE have all been pretty weak. And then if we go back to the bottom panel, it's just a 80 line of the NYSE. I believe it's common stock only. And you can see off the October bottom, although we made a series of higher highs and higher lows just until this last month or two, the AD line certainly didn't zoom out like it usually does early in a bull market, and it was a very, very choppy advance for the average stock. Moving on to chart number 7, we have the first sentiment indicators, the NAAIM exposure index. For the most part, during this recent pullback, sentiment hasn't gotten too bad. The name got down to 36% this week. It was around 34% a couple weeks ago. That's similar to what we saw back in March, I guess. So, we have some deterioration in sentiment, but certainly not to the levels you wouldn't expect to see a deterioration similar to what we saw during the bear market in October of 2022 at the lows. And moving to chart number 7, this is another sentiment indicator. This is the 5-day CBOE equity-only put-call ratio. The last few times we've gotten above about 0.8, and we've been oscillating around 0.8, between 0.75, 0.85 here on the 5-day. That's been generally a good time to buy. Caught the August bounce, and the last couple times it happened during a small pullback here was in March earlier this year when we got up above 0.8, and then certainly back in October, and then back last summer in June.
Mark, and here's what you'd like to add?
Yeah, we can't talk about the technicals unless we look at the Treasury market. I have everything on here. Top panel, 10-year yield. The longer end of the curve has spiked higher after completing these large cups. At the time, I said a cup breakout could equate to a move to 5.25% based on the size of the cup. We got close to the 490 level. We might have hit it this morning, I'm not sure. But that's been the recovery high so far. The angle of ascent here is pretty steep. The market positioning in treasuries, if we go the whole curve, is very bearish. If we look at what hedge funds are doing, I think the one potential savior for the market could be a reversal in bond yields. There's a big short position. That's the reason I'm not, throwing in the towel on the bull, because if we get a reversal in yields to the downside, it could be pretty wicked, because as I said, everybody's sitting on the bearish side. If we look at the next panel, it's the 2-year. 2-year hasn't really done a whole lot, flopping around here just above the 5% level. We're currently today at 508. The next panel, the SPX, that's the 5-year, also very large cup breakout, which equated to a move above 5%. And then if we go down to the last panel, we have the 210 yield spread, which moved out to about 108 basis points in March and then in early July. Over the last, couple weeks, it's about September 20th, we've gone from about negative 75 basis points, and today, currently, we're at 28 bips. The weird part about this is that when we reinvert, historically, looking back to 1960, looking back further. That's generally when the economy has trouble and when the stock market has trouble. We don't generally have the bear market before the inversion. So this is complicated. I really don't know what's going to occur this time, but historically the reinversion has been the time to look out as far as the economy and the stock market is concerned.
Mark, thank you. Have a great weekend.
You too, Ike. Thank you very much.